What up, financial rebels? Your favorite slightly cynical, always caffeinated financial truth teller is back. And today, we're diving headfirst into a topic that makes most personal finance gurus clutch their pearls and whisper to blasphemy. We're talking about debt. Specifically, how the top 1% weaponize it, yes, weaponize, debt, using tax loopholes to build generational wealth that makes your head spin. Ever wonder why the rich seem to get richer, even when they're drowning in what looks like mountains of debt? Yeah, it's not because they're harder workers or smarter in the way your boomer uncle thinks. It's because for them, debt isn't a bug, it's a feature. It's a meticulously engineered, tax-efficient wealth-building tool. Prepare to have your mind slightly blown and your blood pressure maybe tick up a notch, because we're about to expose the playbook. #### Section 1, debt isn't bad, it's leverage, for them, anyway. Alright, let's get this straight, everything you've been told about debt, avoid it, it's evil, pay off your credit cards immediately, is largely true for the average person. But for the ultra-wealthy? That narrative gets flipped on its head like a pancake on a griddle. For the 1%, debt isn't a burden, it's leverage. It's other people's money, OPM, that they use to control assets far greater than their own cash reserves. Think about it like this, your landlord isn't rich because they own a building outright. They're rich because they own a mortgage on a building that you pay for, every single month. They put down a fraction of the cost, borrow the rest, and then you, the tenant, cover the interest, the principal, and eventually, their massive profits. It's like thinking a shovel is only for digging graves when it can also build castles. Debt, for the wealthy, is a shovel for building empires. This isn't about taking on credit card debt for a new pair of sneakers. This is about taking on strategic debt to acquire appreciating assets, real estate, businesses, even certain financial instruments. They're not borrowing for consumption, they're borrowing for production and acquisition. And the kicker? The tax code is basically their biggest enabler. #### Section 2, the tax code's love affair with debt and depreciation. Surprise, surprise, the tax code, largely influenced by those who benefit most, absolutely loves debt. It's designed to incentivize certain behaviors, and owning assets with borrowed money is high on that list. Let's break down some of the juiciest loopholes. 1. Mortgage interest deduction * for the average homeowner, this can save you a few bucks. But for the wealthy, who might have multiple multi-million-dollar properties, whether primary residences, vacation homes, or massive investment portfolios, the interest payments are astronomical. And guess what? Much of that interest is deductible from their taxable income. The bigger the loan, the bigger the write-off. Your average Joe gets a deduction on his $300,000 starter home. A billionaire's portfolio of income-generating properties is basically a tax haven on paper. 2. Business interest deductions, Section 163. If you operate a business, or if you structure your wealth through holding companies, which many wealthy individuals do, the interest on loans taken for business operations or investments is often deductible. This means if you borrow money to buy another company, expand operations, or invest in a new project, that interest expense reduces your overall taxable business income. And for the 1%, their entire life is often structured as one giant business venture. Their private jet might even be a business asset with deductible interest. 3. Depreciation and cost segregation, the actual magic trick *. This is where things get wild. When you own an asset like real estate, the IRS allows you to depreciate it. This is an accounting deduction for the wear and tear of the asset over its useful life, even if the asset is actually appreciating in market value. Think about it, your fancy office building grows in value because of inflation and market demand, but the IRS lets you pretend it's falling apart and losing value on your books. This phantom loss directly reduces your taxable income, sometimes even to zero, allowing you to effectively receive tax-free cash flow. Now, enter cost segregation. This isn't just depreciating the building over, say, 39 years. Cost segregation involves breaking down a property into its individual components, think plumbing, electrical systems, carpets, landscaping, fixtures. Many of these components have much shorter depreciable lives, 5, 7, or 15 years, than the entire building structure. By accelerating the depreciation of these components, the wealthy can generate massive paper losses much faster, creating huge upfront tax deductions that can offset other income. Why depreciate a building over 4 decades when you can get a chunk of those deductions in the first few years? Instant, significant tax savings, baby. ### Section 3, Wealth Building with OPM, Other People's Money, that Infinite Return, and, buy, borrow, die. So, the tax code loves debt, and the wealthy love leverage. How do they actually combine these to build ludicrous amounts of wealth? It's all about acquiring appreciating assets with OPM, extracting tax-free cash, and never, ever selling. The infinite return strategy, cash-out refinancing. 1. Acquire an asset * you, or your entity, buy a property, maybe putting down 20 to 30% cash and borrowing the rest, 80 to 70% debt. Let's say a $1 million property, $200,000 cash, $800,000 loan. 2. Appreciation * over time, the property appreciates in value. Let's say it goes from $1 million to $1.5 million. 3. Cash out refinance * instead of selling, and triggering capital gains taxes, the wealthy refinance the property. They take out a new, larger loan, say, $1.2 million, pulling out $400,000 in cash, $1.2 million new loan, $800,000 old loan equals $400,000 cash. This cash is considered debt, not income, so it is not taxed. 4. Repeat * now you have your initial $200,000 investment back, plus an additional $200,000 of tax-free cash, and you still own the $1.5 million asset, now with a $1.2 million loan, which continues to appreciate, and you're still getting tax deductions on the interest. It's like playing Monopoly with cheat codes, you get your money back, but you still own Park Place, and you owe the bank more, which, again, is actually good for taxes. This process can be repeated as the asset continues to appreciate, creating an infinite return on their initial capital because they got it all back, and then some, tax-free. The buy, borrow, die strategy, the ultimate generational wealth play. This is the holy grail of tax-efficient wealth transfer. It's exactly what it sounds like. 1. Buy assets * the wealthy by appreciating assets, stocks, real estate, businesses, often using leverage/debt. 2. Borrow against them * as these assets appreciate significantly over decades, they borrow against the value of these assets, like the cash-out refi, but also other forms of margin loans or portfolio loans. This allows them to live lavishly and fund new ventures without ever selling the assets and incurring capital gains taxes. 3. Die * when the wealthy individual dies, their heirs inherit these assets. Here's the critical part, due to the stepped-up basis rule, the cost basis of the assets resets to their fair market value on the date of death. This means if an asset was bought for $1 million and is now worth $50 million, the heir's new cost basis is $50 million. If they immediately sell it for $50 million, they pay zero capital gains tax on the $49 million of appreciation. None. Zero. Zip. Zilch. So, the original owner never paid taxes on the growth because they just borrowed against it. The heirs pay zero taxes on the growth because of the stepped-up basis. The only tax paid was on the debt interest, which was a deduction anyway. Chef's kiss for the rich. Heart attack for everyone else. ### Section 4, the generational angle, passing on the empire, tax-free-ish. This isn't just about one generation getting rich, it's about cementing that wealth for centuries. The strategies we've discussed are perfectly designed for intergenerational wealth transfer, sidestepping estate taxes and capital gains taxes with finesse. Trusts and family loans * assets are often held in complex trust structures designed to avoid estate taxes. Beyond that, Intrafamily loans are a powerful tool. Instead of making a taxable gift, a wealthy parent might lend their child millions of dollars at minimal interest rates, often just above the applicable federal rate, which is often very low. The child invests this money, and the appreciation happens outside the parent's taxable estate. Later, the loan might be forgiven or paid back from the asset's growth without triggering significant gift tax events, or simply rolled over. Passing on leveraged assets *. The buy, borrow, die tactic means assets are passed on, often heavily leveraged, but the value has soared. The heirs can continue borrowing against them, using them as collateral for their new ventures, or sell them immediately after the step-up in basis for a tax-free windfall. The cycle continues, perpetually. The wealth compounds, the debt compounds, and the tax burden stays magically low. It's not just about getting rich, it's about staying rich forever, without ever really selling anything and triggering a tax event. It's about designing a system where your wealth isn't just sheltered, it's grown using the very tools that are considered dangerous for the masses. ### Section 5, Why you're not doing it, and how you could. Okay, so why isn't everyone doing this? A few key reasons. 1. Access to capital * banks lend more easily, and at better rates, to the already wealthy. They have collateral, established income streams, and a history of successful ventures. It's a rich-get-richer feedback loop. 2. Knowledge and expertise * These strategies require sophisticated financial and tax advice. The top 1% have teams of lawyers, CPAs, and financial advisors meticulously crafting these structures. Your average financial advisor probably isn't telling you this because they either don't know the depth, or you don't have enough assets for them to care to implement such complex strategies. 3. Risk tolerance * Yes, it is debt. There are risks. Interest rates can rise, asset values can fall. But the wealthy have a safety net, diversified portfolios, multiple income streams, and enough capital to weather storms. 4. Scale * Many of these strategies work best at a significant scale. Depreciation on a $300,000 rental property is nice, but it pales in comparison to a portfolio of $100 million commercial properties. But don't despair. How you can apply some of these principles ****. Smart real estate investing * Use good debt, low interest, income-generating loans, to buy a rental property. Learn about depreciation and how it can reduce your taxable rental income. Even small-scale cost segregation studies can be beneficial for residential rentals. Business ownership * Starting a small business, even a side hustle, opens up a world of business deductions, including interest on business loans. It's a legitimate way to structure expenses and reduce your taxable income. Understand the system * Knowing how they do it makes you a savvier investor, a more informed voter, and a more critical consumer of financial advice. It's about being informed, not necessarily becoming a billionaire overnight. Though, hey, dream big. Seek specialized advice * As your net worth grows, don't just rely on generalists. Find CPAs and financial advisors who specialize in tax-efficient wealth building and real estate strategies. It's important to emphasize, these aren't illegal tactics. They are legitimate, if sometimes ethically questionable, tax strategies within the current legal framework. They're not criminals, folks, they're just optimizing the system that was built around them. Conclusion. So there you have it. The secret sauce of the ultra-rich isn't just about making money, it's about keeping it and growing it through clever manipulation of the tax code and a fearless embrace of debt. They leverage OPM, deduct interest and phantom losses, pull out tax-free cash, and then pass it all on without paying a dime in capital gains. It's a beautifully brutal system. So yeah, the rich get richer, and they do it often by owing more money, not less. Shocker. Hit that like button if you're now slightly annoyed but also slightly inspired. Drop a comment below if you found this insightful, or if you just want to rage against the machine. And definitely subscribe for more spicy financial truths that might just empower you to play the game a little smarter. Now go forth and maybe buy a rental property instead of that new phone. Or don't. I'm not your mom. Just trying to spill some tea. Peace out.